Welcome back to the series of Chinese videos, and yes, I've said series of Chinese videos, and the reason being is if this were one video it would be close to 40 minutes, and that's far too long in my view for one video, but we do have a lot of information to get through, and so as I said, welcome back. Now what we're doing is we're continuing on the series of videos where I've outlined the three major trading zones in the global economic environment. Namely the United States, the European Union and China. And heretofore I've already covered the United States and Europe, although there's been even developments since I've done those videos in the last week or so. So what we're going to do is we're going to focus on China in this next several videos. Now China has got serious problems, and I know everybody's saying, you know, like China's the wonder boy of the world, and it's got massive growth, and it's got a real estate boom, and it's got trade surpluses. But underneath, when you look at the figures, China is in serious problems, and these problems are very similar to those of what are occurring in the European zone and in the US economy as well, and namely it's debt. Debt is the big daddy of all the crises to come, and the central banks throughout the world and the Chinese government, they just don't seem to be able to have the tools to, nor the wherewithal to be able to solve this problem. It's basically like a junkie on a permanent fix, pardon the term. But anyway, so China, as I say, has got major debt problems, but these problems differ from those of the United States and the European zone, because in that European zone I'm obviously including the United Kingdom. Now, why is China different? Well, the fundamental difference in China is its political system. China, whether some of you guys want to admit it or not, is a command economy that has morphed into some sort of hybrid between some sort of rampant capitalist sector and a deeply controlled aspect by the Communist Party, which has been inherited from Mao Zedong. And many of the problems that we see going forward in modern day China is a result of this conflict between control systems of a Communist Party and the urges of a private economy to break free, even though that's not necessarily what's happening or work within it. Now, the Communist Party controls everything. It controls property, finance, and debt, and the ability to create credit. So this is something that's really important going forward in this video series. Now, by controlling the levers of credit and monitoring the debt, and therefore in a way controlling the debt as it thinks, the ability, because it's a completely centralized control system, the ability of the Chinese government to control the internal economy is much greater than that of the Eurozone and the United States. Now, in order to control the credit cycle and debt cycle to some extent in the other two zones, central banks are used, and whereas in China, the People's Bank of China, which is basically an arm of the Communist Party of China, that is the mechanism by which it tries to influence the market. So what we've got to look at is that, so we effectively have a different economic model that exists within China. We've got debt, cash flow, and profit. There are major differences, but the government of China doesn't see any difference. And why is this? Let me explain. In the Western economy, the method of doing commerce is when a company makes a profit, it grows and expands when it reinvests that profit. But it grows and expands at a slower level, even though it does grow and expand, if it decides to reinvest. And if it wants to do it quicker, it acquires debt. But if it acquires too much debt, what happens is that if the profit source cannot repay that debt. There's a liquidity problem, and quite often the company will go broke. Well, the Chinese government's idea of commerce is quite a bit different. Now, what it is, it generates the working capital first to provide the cash flow, and where there is a deficiency, in other words, where the company is losing money, it will provide debt to cover it. And this is the working capital stroke debt model that the Chinese government utilizes for its state-owned enterprises. So effectively, what this means is that they can never go broke because it's so intrinsically important to the Chinese economy. Now, why is this? Because, well, in 1949, when Mao Zedong and the Communist Party took over China, they copied the Stalinist idea of and had a great leap forward. Basically, they reindustrialized the Chinese economic base with steel, all those things that are important for infrastructure. So these were deemed absolute national essential industries, and they still are. So therefore, they, being government industries and being in a command economy, these form the bedrock upon which the new Chinese economy has been built. So now we start to see the structural dichotomy and the bipolar nature of the Chinese economy starting to well, not just starting to, it's always been existing, but because there's problems existing now, that these problems are going to become, and these difficulties to overcome are going to be much more obvious going forward. So basically what we have is we have state companies in the Chinese economy having a get-out-of-jail-free card. I mean, basically, they can use monopoly money. I mean, the money is literally printed out of thin air. Just imagine that. I mean, you can make any losses you want. You can dump any products you want onto any market, and you can underprice the competition. And guess what? Your government is going to bail you out. This is incredible. I mean, we've talked about zombie companies in Europe being financed by extremely cheap capital through the quantitative easing that the ECB has been doing, but the Chinese have been producing credit as well, and their companies, their zombie companies, are on steroids, and so it's no wonder why the United States and other Western countries are looking at trade tariffs, because this is an incredibly unfair trade advantage. But we're not going to get into a political discussion about the whys and wherefores of trade wars at the moment. What we're looking at is cold, hard facts. So basically what's happening is a constant debt jubilee that China has for its state-owned enterprises. Now, the problem with this is, going forward, is that, as I said, there's a dichotomy. There's the commercial aspect, it's more capitalist, and then there's the communist aspect, which is more state-controlled enterprises, basically of the old Russian type, which ultimately failed, as we've seen when the fall of communism in Russia happened. But what's more important in China is that, because the People's Bank of China, in other words, the communist government, funds the state-owned enterprises basically through the banking system, and the banking system knows, the People's Bank of China knows, just like the sovereign bonds, that they have got zero risk of defaults if they lend money to the state-owned enterprises. So all the capital that they lend to the state-owned enterprises to the exclusion of potentially profitable growth companies, which goes back to what I said before in terms of, in the Western idea of capitalism, you have profit, you then have investment, and then you have debt. Well, the Chinese have not really adopted that system. They've got, as I said, their own hybrid system. So what this has meant is that this has forced Chinese companies that are growing or potentially starting to source finance from the other area. And the other area that they're looking for finance is in the shadow banking area. And I'm sure you've heard a lot of about shadow banking. So this shadow banking is really where all the other non-government debt for SOEs must go to get finance. And in order to do that, it's super competitive, and this has caused major problems going forward in terms of the transparency of the Chinese shadow banking financial system as far as figures are concerned, because it's this absolute competition for funds, and a country just cannot grow without some form of capital being supplied to the economy, and especially in the West, private economy, in China, both sides of the equation. So we have a great squeeze going on. Now, why is this important as well is because, well, if we look at this particular slide in front of us, we can see that SOEs account for 80 to 81% of non-financial finances available from the banking sector. So this leaves pretty well close to 19% of the capital available to the non-SOE companies. So this is important from the point of view that if you're only getting 19% of the capital that's available, you're having a major problem going forward. So what we're seeing is, if we look at the slide, we can actually see from this particular slide that back in 2008, okay, we can see that the actual combined debt of the emerging markets in China was 16 trillion, of which China had 7 trillion of that debt. Okay, that was the non-financial debt. Now, fast forward to 2018, and the emerging markets minus China have 29 trillion. And what this means is that their debt has gone up through 2.5-fold in the period of time. I mean, 2.5-fold in the period of time in 10 years. But China's debt has grown from 7 trillion to 40 trillion. And so this is a 33 trillion increase in debt. Now, why is this important? Well, 33 trillion divided by 10 is 3.3 trillion a year. So Chinese net debt is going up 3.3 trillion a year. And this is important because if we think about the stimulus and the rescue package that the quantitative easing in the United States had, the Fed balance sheet increased to 4.2 trillion. It was probably close to 1 trillion. I think it was close to 1 trillion at the time of the crisis. So in 10 years, from 2008 to 2018, the US Fed balance sheet increased by 3.2 trillion, but the Chinese economy is increasing 3.3 trillion a year. And yes, I know I can hear you saying that you can't equate QE debt to corporate debt. Well, yes and no, because what I wanted to show you is the extent of the debt that is being compiled by China, not necessarily the nature of it. Now, yes, and I know also if we look at the exponential growth, when we look back in the US videos, the US has had exponential growth as well in corporate debt, and much of that has been of very poor quality, which we've covered. But it's the same as far as the Chinese are concerned. So what we're having is that we're having a lot of debt that's actually coming on the market that is really, really bad. And why can I say this is because recently, back in November of 2018, there was a company called Kangdai Zinn Composite Materials Group that defaulted on its bonds, and it defaulted on about 1 trillion yuan of government of debt. Okay, now that's about 150 billion. Now this is one company. Well, why is that significant? It's 150 billion in the massive trillions of Chinese companies. Well, it's significant because as of September of last year, the company had reported officially that it had twice the reserves outstanding of its cash flow of its assets. So it had on paper it had a good operating capital ratio. Now, when it went broke, it actually had overstated balance sheet to the point that the 150 billion was 1/16 of the amount of debt that was on its balance sheets. So that is really, and it's not the only company, so this is really a potential indicator of those companies that I mentioned beforehand in the Chinese economy that are overstating their cash position to attract money to finance because of this squeeze on top quality capital. So we're looking at a potential iceberg scenario here of bad debts. And when we look at this next slide, that we can see that we have had an exponential growth in defaults per month since March, February of 2018. There wasn't any defaults. And yet by November of this year, as you can see, it's almost exponential. We've had 20 billion yuan of a default. Well, what's 20 billion yuan? It's close to $3.5 billion. It's about just over 6 the exchange rate. Now, if this continues, then what we're going to see is massive defaults coming through as the economy is squeezed through, whether we like it or not, potential trade conflict or worsening trade conflict with the United States. So this is really important going forward to look at. So you cannot ignore this situation anymore. This is going to come back, and it's going to become very obvious.